Hello, Kelly. So Chair Gensler has just given a major speech here at the Piper Sandler Exchange Conference. And Doug, he's not happy about payment for order flow. Now, this is the process whereby brokers send their orders to market makers like you, Virtu. He says it's riddled with conflicts of interest. He's not happy about the fact that he says there's only a few market makers that are really doing this. He wants more competition out there. Is the average retail trader being disadvantaged here?
I mean, fundamentally, the answer is no. And I think payment for order flow is something that's been around for 20 to 30 years. And it really has fostered innovation and competition within the marketplace. And I should say that within the marketplace, we have roughly 250 broker-dealer wealth management clients that send us retail orders. 95% of them don't take a rebate or payment for order flow. So again, the chair, with all due respect, is conflating the issue of payment for order flow with the ecosystem that has evolved in this country for retail trading, which has really enabled retail investors to have instantaneous execution at essentially zero commission on 8,000 listed names. You know, the cliche that markets have never been better is actually factually correct.
Yeah, I have been covering the markets for 32 years at CNBC, and my impression is the retail investor has never had it better. But what's wrong with more competition? I mean, this is what Gensler is talking about. So, for example, he's floated this proposal about let's do auctions for the retail people, that there's too much power concentrated in your hands, Virtu's hands, Citadel Securities, two of the main market makers
That's a good
out
question.
there. Is there a problem with having auctions?
No, look, we fundamentally at Virtu, and every market participant says we welcome competition. We're not anti-lit exchanges. And today, indeed, broker-dealers, retail broker-dealers, are free to send their orders to exchanges, to ATSs or dark pools, or to wholesalers. There's no obligation for them to send it to Virtu or Citadel. We provide a service. We provide guaranteed execution. We provide meaningful price improvement, $12 billion last year in meaningful price improvement. So we welcome competition from lit exchanges. Yeah. We've put in proposals to say that lit exchanges should be put on a more fair, level playing field with wholesalers. We welcome that because, Bob, we're not internalizing all these orders. It costs us tens and tens of millions and hundreds of millions of dollars to source price improved liquidity on exchanges and provide that back to our clients.
One of the things that you've said for years is you do provide price improvement. Yep. You do actually help improve. You get a better price for it. Can you explain briefly how you do that? Because Chair Gensler has been very skeptical about that.
Well, I'm not sure he's been so skeptical about it. I think some of the data, and he spoke about it today, the need for reform of Rule 605. So essentially, the rule is antiquated. It doesn't really cover the amount of what we call size improvement. And we've been very upfront and very transparent about providing that level of data. So what that means is, in the 8,000 names, to the extent there's not liquidity on a lit exchange, fundamentally the wholesalers are providing infinite liquidity at the NBBO or the inside price. So if we get an order for 1,000 shares in Reg NMS stock that no one's ever heard of, and there's 200 shares on NASDAQ in New York, we fill out 1,000 shares at that inside price. That's meaningful liquidity. 55% of the orders that we received, Bob, we provide size improvement. In a complete, as he calls it, an auction environment, who's going to provide that? The liquidity fairy? I mean, it just doesn't exist.
This is a very complicated proposal. There's not really a rules that's being proposed. Chair Gensler is floating this idea, and the implication is maybe in a few months we'll make a rule proposal. Do you think anything is going to happen here? Do you think there's actually going to be a rule proposed, or are we just going to try to get more transparency, more information? Gensler may have to settle for you providing more information on exactly how much it costs for payment for order flow.
We're all about that. I mean, whatever the rule is in terms of providing transparency around how much payment for order flow, price improvement, set it at the midpoint, we're all ears. We've made those proposals. It's a little bit like punching a ghost right now, right? Because they have these high-level statements that aren't really backed by any data, right? We've provided real data about what we do. We welcome the opportunity. We would welcome a roundtable. I don't know why the chair is not willing to engage the industry directly on this. I'd be happy to come with him on this program.
Wait a minute. You're saying he hasn't talked to you? You're one of the biggest market makers in the United States. Are you saying he hasn't talked to you?
I have spoken to the chair. I would like some more time with him, and I think him coming to the industry and coming to Virtu and understanding what we do and how competitive the marketplace is. He talks about 2 or 3 wholesalers. There's about 10 of us now. UBS is involved. Jane Street, Jump Trading, Hudson River Trading, Susquehanna, Two Sigma. Anybody else can enter this marketplace. There's not a barrier to entry. There's not like an admission ticket that you need, right? It's a competitive marketplace. Every day we're banging heads with Citadel Securities to provide the best service and the best price to 250 clients. And some days we lose, and some days we win.
We'll see if this goes anywhere, but Doug Seafood, CEO of Virtu, thanks very much for joining us. And Kelly, I think the key point here is when I started with CNBC in 1990, it was not unusual for a trade to cost about 1% when you engage in the actual trade itself. And compared to today, where you're still dealing with $0 commissions, the question is exactly how much does it really cost for a payment for order flow? Whatever that cost is, it's a tiny fraction of what it was more than 30 years ago. So there really is something to the idea that the retail investor has never gotten it better. But with that said, maybe we still should have more competition out there. The chairman brought up an interesting point today.
Well, the debate is reaching a frenzy and really heating up. Bob, thanks for bringing us that important interview. We appreciate it.
All right, so a couple things to say about that, and hopefully I can offer not only my opinions, but some clarification. This concept of, does the retail trader have it the best now relative to any point in history? That's a very difficult thing to disprove. My reaction would be, yes, we do have the best environment we've ever had to be a retail trader, investor. I think that's factual. But that also doesn't mean that we can't improve it more. They're almost taking it of like, hey, it's really good right now, so stop complaining. Like, that doesn't make sense. It's like, you wouldn't invent the first automobile and be like, hey, it's better than horses. And everyone's like, yeah, it is better than horses. So like, let's stop working on cars. Like, that doesn't make sense. So I do agree retail has it very good, but we could also make it better, and maybe you could make it better by getting out some of these potential conflicts of interest. So I actually agree with retail has it the best right now in real time than we've ever had it before. The other thing I wanted to talk about was, I thought it was interesting of Doug Seafood, who's the CEO of Virtu, who's the number 2 market maker, number 1 being Citadel. He was even talking about how still it's been this way for 20 years. Well, so the argument is because it's been a particular way for 2 decades. That doesn't make sense to me. We're in 2022, and the digitization of the markets happened around 2005. So we're talking about rules that happened in like multiple market regimes ago. There's so much been going on with the market. So he's like, the rule's been around for 20 years. That should be fine. There have been many things that have, in one way or another, set a historic precedent that is not a good historic precedent to set. So I don't really like that. I think that was like a little bit, I guess, misleading. Just it's been here for 20 years. Why is everyone complaining? Like, I didn't get that at all. It kind of comes down to this of, through market making and payment for order flow, it did lead to the rise of commission-free brokerages. That is accurate. Robinhood kind of kickstarted that. But now we have things such as Public and FTX that do no payment for order flow, and it's still commission free. It is very, very acceptable to continue to iterate and get better and get better and get better. Doug Seafood and Citadel will also argue this, is that they have meaningful price improvement. This is exactly the thing that Gary Gensler in his speech on Wednesday was arguing against. He was saying they're measuring their price improvement off of the NBBO, the spread of the NBBO. But inherently, the way our market structure is, they're making the NBBO worse. So it's basically you lit the fire and then came in and threw a bucket of water on the fire. And you said, hey, look, I helped make there's less fire because of me. So inherently, the measuring rod that they're using, they made worse. And then they're saying, well, it's a slight improvement off the shitty situation we made. But once again, I want to be respectful here and also just a little bit honest of like the shitty situation. It's still pretty good. It's like way better to be a retail trader now than a decade ago, 2 decades ago, 3 decades ago. It is very, very good. But once again, that comes back to the argument is there's no reason why we can't keep improving, especially when you have a duopoly of market makers. I find this funny. So he said that there's like other market makers now of like, and he was just naming like whatever, Hudson, UBS, all of those. Understand that Citadel is damn near 50% of payment for order flow. Virtu's another 20 to 30. So all those other players, like let's just, I don't know how many he said like 10, 20, 30, whatever. There's other market makers. They're all vying for a very small portion of the leftover pie. That's why we say there's a duopoly. Even though there's many other ones, they're all getting like a little sliver of the overall pie. It very much is controlled by Citadel, and the number 2 player is Virtu. Citadel is like, it comes right up to 50%. 50%. And as it gets over, right away it comes a little bit back down and gives a little bit more of the payment for order flow market share to Virtu. So basically it can't get hit with an antitrust, monopoly type of a thing. So those two control a lot. So the fact that he was just randomly naming other ones, they're so small. And then the final thing that I see some people commenting about is the liquidity thing. Understand that that's actually a good thing about market makers. You want more liquidity. You don't want something to be illiquid. So when he was talking about an open auction, let's say you go to, let's just say for the point of this argument that there's 5 lit exchanges, right? Let's say you go to all the 5 lit exchanges and you're trading a stock that's not that popular and you want to buy 10,000 shares of this unpopular stock. Well, if no one's selling 10,000 shares, you can't buy it. If no one's selling it, there's no way for you to buy it. So that kind of is one advantage of these internalizers for the overall system, is they do provide liquidity. Liquidity and volume are two different things. Market makers, and this has been studied, have had a noteworthy pack on, and I think the best way to understand liquidity is the ease in getting into and out of a position, the ease of finding another player who's going to take the other side of your trade. If it was purely this open auction thing, you would be relying on someone else in real time. If you're trying to buy, they would sell it to you. If you're trying to sell, they would buy it off of you. What market makers have done have basically said, well, hey, we'll always buy from you if you're trying to sell, and we'll always sell to you if you're trying to buy. So that's a little bit more clarity on the infinite liquidity comment, which I still don't like. I think that was a little bit verbose, like just mathematically, how much could they have at their own like internalization tools for infinite liquidity? They provide a lot of liquidity, but once again, liquidity is a positive thing. You want liquidity. Within the ape community, liquidity commonly gets confused with capital. And I get it, because if you just Google liquidity and like you think about it in your own personal finances, you're like, oh, like I'm liquid right now. I have $5,000, like something like that. But understand in the stock market, liquidity and capital are two distinct things. And it's important to understand that distinction. Liquidity is the ease in which you can get into and out of a sizable position. You want high liquidity on everything. That's a good thing. The more people engaging, that is a very, very good thing. If it's illiquid, that's when you can get really wide spreads and you get like funky jumps up and down in the market or in the chart. That's not a good thing. And then capital, which a lot of people are thinking that capital is liquidity. Capital is actually just the money of like, how much capital do you have? Oh, okay, this hedge fund has $100 million. They have like a free capital of $1 million or something like that. So just a little bit of terminology to get us like kind of all up to date there. And I didn't know about that video. So I'm happy you guys brought it to my attention. I appreciate that.